Picture this. You're scrolling through TikTok at midnight. Some 19-year-old finance guru in a rented Lamborghini points at a chart on his phone and says, "This stock is going to the moon tomorrow. Get in now or regret it forever." Your heart races. You open your brokerage app, dump your savings in, and wake up the next day thinking you're a genius. But then, boom, the stock tanks. You didn't get rich. You just paid tuition to the school of don't follow hype. Here's the deal. One of the biggest beginner mistakes in 2025 is chasing hot tips. Whether it's from a social media influencer, a random friend, or even a sketchy Discord group. Markets today move faster than ever, and by the time you've heard the secret, it's already baked into the price. Hype-driven investing feels exciting, but it's basically gambling with better branding. You're not buying based on fundamentals. You're just buying because someone yelled loud enough online. The smarter move? Slow down, research. Look at the actual company behind the ticker. Does it make money? Does it grow consistently? Does it even have a future? Because in investing, you don't win by being the loudest or the fastest. You win by being the most patient. Mistake number 2, timing the market instead of time in the market. You've got $1,000 ready to invest, but instead of putting it to work, you sit there refreshing stock charts like it's a video game. You tell yourself, "I'll invest when the market dips just a little more. That's when I'll make the perfect move." Weeks pass, months pass, even years. The market keeps bouncing, but you never feel like it's the right moment. Congratulations, you've just made zero progress. This is called market timing, and it's one of the most common rookie mistakes. The idea sounds logical: buy low, sell high. But in practice, nobody, not even the so-called experts on Wall Street, can consistently predict the perfect moments. Here's what usually happens instead. You wait too long, miss the growth, and end up buying when things are already expensive. Or you panic when prices drop, sell everything at a loss, and lock in the exact opposite of what you wanted. The truth is, wealth in the stock market isn't about finding the perfect day to buy. It's about spending the most time invested. History shows that missing just the 10 best days in the market over a 20-year period can cut your returns in half. Half! And those best days, they often come right after the scariest crashes. So the hack is simple. Stop waiting for the perfect moment. Start early, stay consistent, and let time do the heavy lifting. Because in the long run, time in the market beats timing the market every single time. Mistake number 3, putting all your money in one stock. Your cousin tells you about a company he swears is the next Apple. You buy in heavy, like all in heavy. Your entire savings parked in one single stock. At first, it's thrilling. You watch it climb 20%, 30%, 50%. You start daydreaming about quitting your job, buying a yacht, and casually telling people you retired early from the markets. Then, the company releases one bad earnings report, or a CEO gets caught in a scandal, or a new competitor shows up, and suddenly your safe bet crashes 60% overnight. That's the risk of not diversifying. Investing in just one stock feels powerful, like you've cracked the code. But it's the financial equivalent of putting all your eggs in one basket and then handing that basket to a toddler. Even good companies can stumble. Tesla, Apple, Google, every single giant has had stretches of brutal losses. And if that's all you own, your entire portfolio sinks with it. Diversification is boring, I get it. It's like ordering the salad instead of the triple cheeseburger. But boring is often what keeps you alive in investing. A mix of stocks, ETFs, bonds, maybe some real estate. That's what gives you balance. Because you don't just want to win big one time. You want to win consistently for decades. Mistake number 4, ignoring fees and hidden costs. You've got a shiny new brokerage account. You're ready to invest. You deposit $5,000, pick a couple of ETFs and stocks, and feel like a financial genius. A few months later, you check your balance, and it hasn't grown as much as you expected. Confused, you dig into the numbers. That's when you notice all the fees, trading fees, management fees, fund expense ratios, account maintenance charges. Suddenly, your $5,000 investment isn't really $5,000. It's more like $4,850 after the hidden tolls. Investing isn't free. Brokers, mutual funds, and even some ETFs take a small cut, and over time, those tiny percentages eat away at your returns like termites in a wooden floor. Let's put it in perspective. Investing $10,000 at a 7% annual return for 30 years without fees turns into about $76,000. But if fees eat 1% every year, your $10,000 only grows to about $57,000. That's $19,000 lost just to fees. The hack here is simple. Pay attention. Look for low-cost index funds or ETFs, minimize trading costs, and understand exactly what each investment charges. Even small savings on fees compound into big wins over decades. Mistake number 5, letting emotions run the show. The market drops 10% in a week, panic sets in, your stomach twists, you tell yourself, I need to sell before it gets worse.
You sell everything. Relief floods in for a second. But then 2 months later, the market rebounds, leaving you staring at a pile of missed gains. This is the classic trap of emotional investing. Greed and fear are your silent enemies. Greed makes you buy when everyone else is hyped. Fear makes you sell when everyone else panics. Both decisions usually come at the worst possible time. Investing isn't about predicting the next meme stock. It's about steady, rational decisions over long periods. The trick isn't trying to feel the market, it's training yourself to ignore your feelings and follow a plan. Set rules for when to invest, when to rebalance, and when to hold. Don't check your portfolio multiple times a day. If it drops 5% overnight, it's not the apocalypse, it's just the market doing its thing. Over decades, emotional decisions are one of the fastest ways to sabotage your wealth. Mistake 6, not understanding what you're buying. You're on your phone, scrolling through your brokerage app. You see a stock called Quantum Tech Inc. The chart looks amazing, the price keeps going up, and the news says it's the future of everything. You buy in. Months later, you realize you don't actually know what the company does, how it makes money, or why anyone would ever need its product. You're invested in a story, not a business. This is one of the most overlooked mistakes, buying without understanding. Investing blindly is like betting on a horse because it has a shiny mane. You might get lucky once, but over the long term, ignorance costs more than mistakes you understand. Before you invest, ask yourself, what does this company actually sell? How does it make money? Who are its competitors? Could it still exist in 5, 10, or 20 years? If you can't answer those questions, it's too risky. Mistake 7, overlooking the power of compounding. Imagine you find $100 on the street and put it in a magic wallet. Each year it grows 7% by itself. Not much, right? But you leave it there, year after year, decade after decade. After 30 years, that $100 becomes, well, around $760. Here's the thing. Most beginners ignore compounding. They chase big wins now instead of small, consistent growth over time. They treat investing like a lottery ticket instead of a long-term engine. Compound growth is slow at first, almost boring, but that's exactly why it works. Like planting a tree, the first few years you barely notice it, but after decades, it becomes a giant oak. Missing out on compounding is like refusing to water a seed and then wondering why your forest never grew. Mistake 8, failing to plan for the long term. You invest $2,000 in a stock or ETF today, but you have no plan, no goal, no timeline. You just hope it grows. Years later, you're stressed. Retirement is far away. College tuition is looming and emergencies pop up like uninvited guests. You start panic selling, chasing short-term gains, or worse, pulling your money out entirely. This is failing to plan. Investing without a long-term strategy is like sailing across the ocean without a map. You might get lucky, but you're more likely to drift into dangerous waters. A simple plan changes everything. Set clear goals: retirement, home purchase, financial freedom. Decide how much risk you can handle. Pick investments that align with those goals. Stick to it, only adjusting when life changes. Investing isn't a sprint, it's a decades-long marathon. Treat it that way, and you'll avoid a lot of stress and mistakes along the way. Mistake 9. Ignoring inflation and the real value of money. Picture this. You stashed $10,000 in a savings account because you're playing it safe. A year later, your account balance is still $10,000. Feels good, right? Here's the problem: inflation. In 2025, even moderate inflation of 3 to 4% a year quietly eats away at your money's purchasing power. That $10,000 now buys less than it did a year ago. Many beginners make the mistake of thinking safety equals security. In reality, doing nothing can be just as dangerous as losing money in a market. Your money might be safe from volatility, but it's losing value over time. Investing, even conservatively, is the only way to fight inflation. Stocks, ETFs, bonds, and even real estate have historically outpaced inflation over the long term. Let your money work, or it quietly shrinks while you sleep. Mistake 10. Ignoring your own financial education. You hand your money to someone else because they have a fancy title: financial advisor, broker, or influencer. You never learn what's happening. You never read a balance sheet, understand a dividend, or know the difference between an ETF and a mutual fund. This is one of the biggest mistakes of all: thinking investing is magic or only for experts. Investing is a skill, not a lottery ticket. The more you learn, the more control you have over your future. You don't need a PhD in finance, just curiosity, patience, and consistency. Even understanding the basics of compounding, diversification, and fees will save you thousands, if not tens of thousands, over your lifetime. Investing isn't about luck. It's about patience, learning, and making smart choices over time. Avoid the common beginner mistakes, stay consistent, and let your money work for you. If you found this video helpful, hit that like button and subscribe.